All right, I guess I'm live now. I don't know. There's always a delay between StreamYard and YouTube, so I'm not quite sure. And now I can see myself on YouTube as well. Good afternoon, guys. Not a lot of warning today that I was going to do a live stream. I wasn't sure that I was going to be able to. I've been pretty busy this week, but happy that I am. Don't have anything formally planned. No guests this week. I'm happy to answer questions that you guys have about finances, stocks, whatever, even about beer. And folks, I'm going to make this sort of a regular Wednesday thing. Take a little break during the middle of the week while my kids are doing their violin lessons, and let's talk about the economy. Let's talk about stocks. Let's talk about current trends. The video that I made 6 months ago on the metaverse has absolutely exploded. It's got over 100,000 views, which for me, that's pretty good, right? I mean, I'm a small YouTube channel, so Epic Hamster says cheers. He promised me that this week I would not be the only one drinking on my live stream. And Infinite says, first of all, what beer is it? This is a St. Archer Hazy IPA. So a couple of the guys that I do jujitsu with, we're big, artisan beer drinkers, and we're always like passing around things we like. One of the guys from my academy, a guy named John, we call him Panda John, actually bought this for me last week. For my birthday. That was last month, but there we go. Hey, Jason, let's not make it all about money. We are friends here. What's your favorite beer? Oren, and by the way, I do remember your comment from last year where I invited you to come train at my academy in San Diego. So when you make port here, let me know in the comments and we can go train jiu-jitsu. If you've never done that before, that would be great, and I'd love to learn some judo from you too. But anyway, I don't know if I have a favorite beer. That would be kind of, my beer tastes have evolved quite a bit. Like I started drinking beer when I actually lived in Belgium when I was a teenager, and that's kind of where I started appreciating really good beer. But so I kind of didn't like American style lagers for the longest time. But now, 30 years down the road, the United States has tons of great beer. We're really in a golden age of beer here. And it would be really difficult for me to choose a single beer that I really, really like. But I do like a lot of the San Diego local beers here. So, yeah. Moonboy says, thoughts on Sofi earnings? And yeah, so let's talk about Sofi earnings. You guys know I'm a big proponent of Sofi. I've been on board with them since before they went public, before the merger. And recently, I think I mentioned that I'm actually going through a mortgage refinance on one of my properties right now. And SoFi's process so far has been very, very easy. There's no fees associated with applying or anything like that. Of course, you do have to pay things like an appraisal fee and a few other things like title fees, things that you can't avoid. Those are apart from the actual refinance process. As part of like the title change process. Anyway, SoFi's interface is actually pretty easy to use, particularly on their loan end. On the trading end, it takes a little bit of getting used to. I can see why a lot of people wouldn't necessarily like their trading app. It's not set up like a traditional trading app, and you can't do options. And while I don't necessarily trade a lot of options, I do sell quite a bit of in the way of options. So I don't use that as my main invest app, but I am using SoFi Money. I am using their SoFi Relay, and I'm actually refinancing a loan, one of my rental properties right now, which is actually really great. So let's talk about the earnings. So I haven't had time to do a deep dive in the earnings. I've just read articles about the earnings. I haven't actually torn apart the actual paperwork that they sent out myself yet. I'll be doing that. But it's telling the same story that I've been harping on you guys for the last couple of months, that SoFi is a growth story. And it's a steady growth story. And it's not necessarily a spectacular growth story in the fintech space. Or at least it's not going to look that way in context now. When you go back 5 years from now and you start looking at the growth of the mobile only or mobile forward, SoFi, where they're building out this entire ecosystem, in retrospect, it's going to look like incredible growth. So essentially 100% growth year over year in memberships is completely expected. I'm really happy with their growth. Galileo, the technology platform of Galileo, you should see that making up a larger and larger and larger percentage of their overall revenues here in the future. So, so Chris Palmer says, cheers to SoFi aftermarket earnings today. Absolutely. So I kind of made a mistake actually when I was selling. I made two mistakes recently when I've been doing options, and I made a mistake with SoFi, not a huge mistake, but I ended up selling a cash secured put at 22 and a call at 25. That is actually way too narrow, and luckily both of those can't be true at the same time if the expiration dates are the same. But it does create kind of an issue here where I threaded that needle a little too much. Shares still might get called away at 25 by Friday, but at least I'm not on the hook for that cash secured put at 22 at this point. Although, to be honest with you, I'm pretty happy to own SoFi at 22. I want to get it as cheaply as possible, but I'm pretty happy to own that at 22. And because I think that this is 2 years, or a year from now, this is a $40 stock is what I think. I think by this time next year, the conversation we're going to be having about SoFi is SoFi going to break $50 a share by the end of 2022? I think that's the conversation we have. I think it hits 40 for sure by the end of 2022, but is it going to hit 50? And I think that leading into 2024, kind of just like all the experts think so, I think that's when we hit profitability. It's going to look like on paper that's really, really close at the beginning of 2023, but I anticipate they're going to be spending a lot more money on expansion. One of the big catalysts that people aren't talking about is the fact that SoFi Stadium is actually going to be hosting the Super Bowl this year, which is a gigantic branding opportunity for them. I watched somebody else's video on YouTube. I can't remember the name of the video or the guy, but I really want to give him credit. But he was stating that a lot of research has shown that these branding efforts don't necessarily work for a lot of these companies. And I'm sure if you're an oil company out there, or an orange juice company taking over a stadium and putting your branding all over it, it's not going to create additional brand awareness. In the case of SoFi, however, especially in conjunction with our new Get Your Money Right campaign and Bring It Over campaign, which apparently, if you haven't seen their commercials, if you join SoFi, apparently your dance moves improve immensely. Anyway, so I am very, very happy with what SoFi has been doing so far. And I am extremely glad that I was an early investor in them. And I'll be acquiring more shares of SoFi up to the limit of shares that I should have in any single company, right? I'm a little over allocated in terms of that. Like, I generally don't have more than about 10% of my net worth in any single asset, just because I've seen just about every plant on the planet blow up and explode at some point. But I am over allocated to Tesla at this point. That is the one stock that I would love to add more to. I bought a Leaps contract, earlier this week, which was, unfortunately, the market took a dive right after that. But the Leaps contract is committed to being a long-term investor, as well as I'm a long-term investor anyway. But I'm over-allocated to Tesla at this point. I'll probably be looking for other avenues for investments to go. So Maurice L says red or green tomorrow. So Marie L, I'm actually red-green colorblind. So all of that is, I actually can't, when I actually log on to my apps, sometimes I can't tell if things are up or down until I look at the actual numbers. But honestly, I expect further negative reaction to inflation numbers that are out. The argument I hear a lot of people, including a lot of people that I respect, are telling me that inflation is here, it's never going away, it's going to last forever. And I'm saying that this is mostly due to supply shock. This is not the 1970s again. This is not stagflation again. This is mostly due to supply shock, which we've had several cases of this before. Like, you guys may not remember, but in 2011, we had a similar spike in inflation. And of course, the inflation bears and the Ray Dalios of the planet said that this is the end of the world and the end of the US dollar, which for as long as I've been involved in the financial industry, I've been hearing that. And I think, though, that this is transitory, but here's why it's transitory. And it's mostly about competition. Everyone thinks that prices are going to stay high because, shop owners and business owners are going to be used to charging these rates. And I'm like, oh, my customers are just used to it, I'll leave it there. Well, in a perfect world where you had no competition, you could probably do that. But once supply chains become more normalized, of course, we see that race to the bottom in terms of pricing. And that's basically the free market will force prices down after supply shocks end. But supply shocks lasted longer than most people think they have, and they're probably looking to last into next year with a number of different things that have like really, really long supply chains. Like, if you have a chip shortage, a semiconductor shortage, you can't just spin up a new factory, right? Even this stuff that was taken offline, the assembly lines that were taken offline, it's going to take 6 months to build back up your production capacity there. Jonathan Upadhyay, I can't ever pronounce your last name, I'm sorry. But you said, I think that earnings went well. So my earnings went well. I do too. So I have a generally positive opinion on that. I need to dig into it a little bit more, though. I want to make a follow-up video on that. I've been a little bit busy this week, but yeah. So Epic Hamster says the trading app does need some work. I agree. Just joined myself. I agree. If you're so the layout is just something that I'm not necessarily used to, but if you're a new investor and that's all you know, then I'm not sure that you wouldn't think it's just like any other app. So Chris Palmer says, thoughts on inflation concerns? Do you feel it's more of a short-term supply issue? Well, I addressed that without actually reading your question, but there we go. So Tran says, Jerome Powell, leave or stay? That's an interesting question. So what got us through the crisis of 2020 without basically a new Great Depression was a combination of Congress turning on the spigot in terms of liquidity and the Fed turning on the spigot in terms of liquidity. That is something that's easy to do politically. It's easy to create liquidity and spread money around politically. The hard thing to do politically is going to be turning the spigot off. Now, if Jerome Powell, and here's the thing, when the spigot starts to get turned off, there's going to be a little bit of an overreaction here because money has been so free for so long that, you know, paying 0.5% on an overnight loan between banks is just actually going to cause a bit of a liquidity shock here. And we're going to see some of that dry up. I don't see, I've heard the number 2% over and over and over for the 10-year treasury, people saying that a 2% 10-year treasury means that money's going to get sucked out of technology stocks. So I disagree with that to a large degree. The real question when it comes to the stock market and interest rates is really on the short term. There are millions upon millions of people that would rather have a 6-month CD at 5% interest. And I know this from working at a bank brokerage. Tons of people with $1 million sitting in the bank that would rather have a 5% CD for 6 months than be involved in the stock market at all, dividend, anything, whatever. They would rather be in a CD earning a risk-free return. So that risk-free return has basically not been here since 2007, right? You've not been able to get that. I think that the best CD rates since then have been about 2%, 2.25% on a year, right? So it's been a long time since we've seen that. So if we see short-term interest rates go up significantly, where the Fed is really trying to suck money out of the economy and really kind of put the brakes on the economy, that's when you see short-term interest rates like a 6-month CD at 3%, 4%, and 5%. That's when we start to see the stock market not just slow down, but actually kind of suffer to a degree. So, So in terms of Jerome Powell, I don't know if he should leave or he should stay. The question is he going to have the political will to? And I don't know that he necessarily should start clamping down on money supply right now. I don't want to try and outguess the Fed. They have a lot better information than I do. But I do think that it has to happen at some point, if only to be prepared for the next crisis, because right now they are running out of weapons to use. So so that's my opinion on that. Anthony Walker says, why people hate China, US is not better. Well, I don't hate China. In fact, I'm a big fan of China in a lot of ways, big fan of the Chinese people, not a huge fan of the Chinese government. However, there are a lot of reasons to enjoy living in the United States a lot more than you would in China. Number one, and I don't want to go into politics, but a lot of it has to do with politics. That's not what my channel is about. But I think China is an enormous business opportunity. I have great respect for the culture, traditions, and people of China. Not a huge fan of the government, and I bet that they would probably say the same thing about us, right? And Jonathan says, I can't say that Ray has been consistent. That is true. Let me see here. Any thoughts on Tesla's discussion with the Quebec government on battery production? So I think that the news coming out of Tesla there's so much of it coming out. It's all so good that I think that there's a little bit of positive fatigue in some way when it comes to Tesla. Tesla's biggest bottleneck in terms of their production has actually been cell production, right? They just don't have enough battery cells. This is one of the reasons why the Tesla Semi has been delayed over and over and over, because the amount of cells that you need in a Tesla is a lot more than what you in a Tesla Semi is a lot more than what you need for like a Roadster or a Model S or something like that. And so I think it's important discussion, but it's probably not the only discussion they're having. It's not just in Quebec. It's going to be all over the world that they're having discussions with governments and businesses to start making battery cells en masse. I am looking forward to the day when they start looking at alternate cathode chemistries. And I'm not just talking about some other version of the lithium ion chemistry. I'm expecting at some point that we're going to see some sodium ion batteries coming out or potassium ion batteries coming out. Those are the next two candidates in terms of energy density for batteries. And we may see some replacement, like Tesla's long had a 12-volt battery in their vehicle to power certain things. It was lead acid for the longest time. They just switched it over to lithium. That would probably be the first thing that they would switch over to a sodium ion battery or a potassium ion battery, maybe when we have that $25,000 mass market vehicle, or it may not be Tesla, it may be someone else that does an alternate battery chemistry. So no, I'm very interested in that discussion. And here's the thing. I think that Tesla's expansion into India is coming at some point. They're going to make a very good manufacturing and shipping hub for there too, and it's the distance between, So I don't expect that anytime soon that we're going to see a Tesla gigafactory anywhere in Africa. There are a couple of candidate spots where you could put a place. We're looking for a place that has political stability, though, so that narrows down the list of candidate countries pretty significantly. But India is a great place to ship from when you're looking to, and the Indian diaspora has plenty of economic and social contacts, particularly in East Africa, with that wealthy business community that can afford a Tesla. So I really expect that Tesla is going to be announcing sometime in the next year or two that they're opening up a factory in India. And like I said, they are not just looking at the technical and mechanical engineering part of Tesla. They're also looking at how Tesla's brand spreads by word of mouth, and it does that through social networks and having access. Because right now, if you have a business in China, you have business with the entire Chinese economic diaspora located all over the West Coast of the United States, all over Southeast Asia, and essentially all over the world. The same thing could happen with that Indian community as well. And I think this is something that a lot of people don't think about, and Tesla doesn't necessarily talk about, but I can guarantee you that in any business, in any discussion of expanding manufacturing capacity, that comes up. I know because it comes up in other industries as well. So particularly in the financial industry, one of the reasons why folks why every major wirehouse has offices in Singapore is not just because it's a major financial hub, but it's access to those two different business diaspora communities there where there's tons and tons of money, right? And Singapore is really kind of the meeting place of that Chinese economic diaspora and the Indian economic diaspora, right? And if you've never been to Singapore, number one, don't spit on the sidewalks or chew gum. But number two, it's actually a fascinating place to visit. It really is. And if you've ever seen that movie Crazy Rich Asians, that's kind of the place where it's modeled off of. But there's more than that bubbling under the surface of that country. That's an interesting place to visit. So let's go on and see if we can answer some questions here. GC says, any tech startup tips? Do you mean starting your own tech company or investing in tech startups? So also, how do you think that the Libor transition will affect markets? GC, that actually remains to be seen. And the outgrowth of the Libor transition, it really came on the heels of two really big scandals in the last 10 years. And how you track and create that benchmark is going to be changing here in the near future. And so a lot of loans in the United States and credit lines are based on the Libor, which is the London Interbank offering rate or something like that. But it's an interest rate that's published every day, and it's supposed to be based on this floating rate. Well, as it turns out, over the last 2 decades or so, there's been several instances where that's just been massively manipulated, and it affects lots of people in the U.S. Like I have a loan on one of my rental properties that's like Libor plus 2.25% or something like that. So the fact that the Libor was made artificially high or artificially low actually cost me money in terms of the interest that I was paying. But as things stand, there was actually nobody for me to sue in that case because this is not something that's handled in the U.S. But now they're going to a new way of actually managing that. And so no, that remains to be seen. GC, that's not something that I've studied in depth. I'm not on the loan side of the business and finance so much. So let me see here. Demo says, would you buy an NFT? So at this point, I would not buy an NFT. I'm not involved in any NFT communities, but in the future, we're all going to be buying NFTs. Okay. And NFTs are going to be representative of a lot more things than just digital artwork right now. And as we're going forward, it's going to be representative of a lot of digital properties and digital real estate. Right now, you're thinking something like Decentraland. Why would I buy a plot of land? It's more than that. A lot of the way when we look at the metaverse right now and NFTs and crypto, think about this. What's happening with the metaverse right now is a lot like what was happening with the internet back in the late 1990s. We all knew that something was happening. We just didn't know what exactly was happening. Right? You could have chosen any 100 internet companies with .com in their name to invest in at the end of the 1990s, thinking that things are going to go really, really well. 95 out of 100, maybe 97 out of 100 of those companies ended up going out of business or being sold for pennies on the dollar to a competitor or absorbed by a Google or something like that, largely because their business ideas just failed. Something relatively similar is going to happen with the metaverse in this case. So I can't tell you, there's going to be multiple metaverses, number one. I would keep an eye on Epic Games. I would keep an eye on Roblox. I would keep an eye on Unity. I would even keep an eye on Facebook, although I think that Facebook may have already shot themselves in the foot because of this. But no, so the issue with NFTs, though, is that one of the guys in the comments of the video that I did 6 months ago brought up, like, hey, when you have an avatar in the metaverse, now you have a pretty stocked avatar and you can choose a few embellishments. In the future, you're going to be able to buy like clothing for your avatar that's unique, that no one else is going to have. And that's going to be sold to you as an NFT. So, well, number one, that idea is something that I'd simply not considered before. Number one is I don't play those games enough, but in the future, we won't be playing the game so much as we'll be doing business in the metaverse, like having meetings in the metaverse. I'll be doing investor presentations in the metaverse. We might be doing, live streams in the metaverse, like talking, sitting in a room and talking, here in the future. But no, we're all going to be buying NFTs for a lot of different things. I don't necessarily think that the way we're investing in NFTs right now is anything more than what Adam said on our last live cast. It's more like owning a piece of history at this point. So, yeah. Owen says, I know you're a long-term investor, but what are your thoughts on trading a combination of MACD, RSI, and stochastic slow with EMA? I've learned this combo and customize it from So the problem with we're looking at like sales indicators like that, where things are overbought or things are oversold. You're looking at moving averages, all that stuff. All of that technical analysis may help you buy in or sell at a particular price within a real short time frame, and you're going to get a better price for it either on the buy or the sell end. The problem is there's no proof that any of that actually works on a long-term basis. There's no proof that people who depend on technical analysis or fundamental analysis, for that matter, actually beat just long-term buy and hold investors. And when I say there's no proof that the finest professional investors can do this on a consistent basis. But most of the folks who are actually professional money managers, they don't really use technical analysis at all. They don't really use technical indicators at all in order to what they're looking at mostly when you're looking at active managers is they're looking at fundamental analysis. Even though they may have a very different philosophy than a Warren Buffett does, most of them are actually doing their research like a Warren Buffett. They're looking at companies that have a competitive advantage or they've set a pace of innovation and have a culture that encourages innovation, and they're investing in those companies, and they're doing it kind of on a longer term basis. One of the reasons I've been a little bit surprised lately with the active trading that Cathie Wood has been doing around a couple of different stocks. Of course, she's been on the bandwagon with Zillow for a very, very long time. Zillow massively screwed up. I don't think we're really going to know the extent of how badly they screwed up until a couple quarters from now. So they disposed of a lot of properties, particularly in Arizona, for a lot less than what they paid for them. So a lot of that was done through short-term financing. So that now they have debt on their balance sheet, and they no longer have the assets that they can sell to pay that off. So they're going to have to do that by generating income in a different way. So I'm not entirely certain of how bad it is for Zillow. I still think they have a relatively decent business model. They just screwed up, and I think that a couple of quarters from now, maybe just a month or two from now, maybe a really good time to buy Zillow for a long-term growth opportunity. That's just my opinion. So I own a little bit of Open Door. I own 100 shares of Open Door. I haven't actually looked at it for quite some time. I do see this as sort of an opportunity for them. This is another Chamath Palihapitiya SPAC. It's one that I was actually pretty impressed with when I looked into it. When I started comparing it to like Redfin and Zillow, though, my concern was competition. Right at this point, right now, some of that concern is going away. I see this as an opening for Open Door. There are a number of Chamath Palihapitiya SPACs that I'll be avoiding here in the near future. That market has dried up a little bit anyway. So hold on. Lion Electric also reported today slow and steady growth. I know you don't know a lot about them, but I would love for you to take a look. So actually, you've mentioned Lion Electric a couple of times, and I've only done a cursory look at them, so I can't really comment. And that the commercial side of that is something that especially the last mile delivery side, like Workhorse, that's something that I haven't looked at quite as much. But did you see Rivian's IPO today? That was very, very impressive. They raised a lot of money with their IPO, a crap ton of money with their IPO, which is going to help tide them over, right? That's going to put cash in their pockets. It's going to allow them to scale production. And remember, that full-size truck is the best-selling vehicle in the United States, and the F-150 has been that best-selling vehicle for 40 years. I say this on almost every live stream. Rivian got there first in terms of putting a truck in customers' hands. They've delivered a few at this point. They're going to deliver a couple hundred by the end of the year, and they're looking at doing close to 100,000 next year, which they're not even concentrating on a truck. They're concentrating on these last mile delivery vans for Amazon. Is it Amazon? Yeah. So I think Amazon owns like a 20% stake in them. That is going to be their production on that is going to tell the big story about how successful they're going to be. Right. All right. So actually, you know what? I am not going to recommend this St. Archer Hazy IPA. There's something a little bit off about it. If I was ever hoping of getting sponsored by St. Archer, that's gone. Let me see here. Oren Grabarnik says NFTs are just the new trading cards. I like the UFC ones. They're hockey cards that can't be damaged. You can sell Charizard for like 10K today. So I have kids, so I know who Charizard is. But I actually am just old enough to have missed all of the Pokemon thing. But I will say, Oren, that NFTs go a lot further than just trading cards. And we don't even know where they're going to end up in the future. But they're going to be representative of a lot of unique digital property, not just trading cards. It's going to be for like very useful items as well. So we're going to see. It's not like someone owning the person making that 6-second video of somebody making that game-winning shot. That's interesting, but it's going to be representative of a lot different things here in the future. And it says crypto people have stupid money. A fan will pay you for it. I'm looking forward to when Adam gets back from Lisbon, and he's at the Solana conference there right now, and we're going to have him on the show again to talk about different Solana projects and crypto, and he can tell us all about the stupid money that's being spent on NFTs. Man, he's told me some stories that I'm not sure that he wants me to to talk about. But yes, you are correct. The money that's going into crypto is stupid money. Part of it is collector's item stuff right now. But I'm telling you, NFTs are not Dutch tulips. They are something else, and we don't even know what this is going to evolve into at this point. All right. I love the Dutch tulip story. That's another thing that I bring up pretty frequently. Chris Palmer says, I bought Open a few months back after you did a video on it, up 60% now. Thanks for your input. Is Zillow's downward pressure a reflection of a slowdown in the housing market? So Zillow got burned by the one market that seems to have burned almost every big real estate investor that's ever been my client as a professional. Arizona is tricky. Arizona is a very volatile market, and it's particularly around Phoenix. I know a lot of people that have gotten burned on the Arizona market where they got overstretched, they borrowed too much money, and the market was irrational just long enough for them to become insolvent. And I know that's happened to a lot of people, right? So it's close enough to California that a lot of California investors think that they're going to get California-like returns. But really, that market is far enough from California that it doesn't behave anything like it. So I think that Zillow kind of fell victim to the same phenomenon or a similar phenomenon that I've seen over and over and over, and that's just the overextension of their credit line, and prices didn't move in the direction that they thought it did quickly enough. But is the property boom over? The property boom is really fueled by the profusion of cheap money out there. And as soon as interest rates rise in the slightest, I think we're going to see a pullback in the property market. Like my house is up 50% from where I bought it. And I don't feel like it's worth what it's worth. It's not real to me. It's like when Tesla hit $1,200 a share. Yeah, I think Tesla's worth $1,200 a share 8 months from now, 9 months from now, after Giga Berlin and Giga Texas are up in full production. I don't think it's worth that now, right? It's like a forward-looking statement here for Tesla. But real estate doesn't work like that. There's no forward-looking statement or growth statement when I'm looking at my property. Like I don't think it's worth what it's worth today. And it's gone up, 40, 50% just in the last 3 years. And that all has to do with cheap money. It's very cheap to borrow. So for basically the basic formula here, we're in Southern California, is that for every 1% raise that you get in interest rate, you're going to pay about $1,000 more on your mortgage. That's going to price, and it's less than that based on how much you borrow, of course. But that's going to price a lot of people out of the market. And in many major city markets right now, the number of households that can actually afford a median price home is well under 20%. If that number drops to like 13 or 14%, which it has in the past, we're definitely going to see a decline in house prices. So GC says, starting your own tech company. Well, GC, the first thing you said is like any advice for starting your own tech company. The first advice I have is have a great idea that no one else has and have a way to execute. So I've never had a great tech company idea. I own a number of different companies. I've never had my own great tech company idea, my own great idea for an app or anything like that. I've been a minority owner in a lot of things that have done really, really well, but I've never done that. So I can't really give you advice on that. So Jonathan says, I can't comment too much on the Libor transition, but not sure how replacing it with a rate and no term structure actually solves anything. No, it doesn't. And that's, honestly, that's almost a topic for a separate video. And you would need to delve into the history of how Libor was manipulated and how people lost faith that the rates published by Libor were actually a reflection of reality. So, yeah, I'm not sure what that's going to solve either. It's not something I've been following a lot lately. So I don't hear much on YouTube or about Libor transition that will affect trillions of dollars, but I see a lot of meme videos and tweets. Well, yeah, like I said before, GC, I think that's because people lack the historical depth on that, and that in the last 5 or 6 years, there haven't been a ton of loans linked to Libor. That was really like 2002 to 2008 timeframe is when you saw the most amount of loans linked to the Libor. So in fact, I haven't been offered anything in the last maybe 10 years whenever I've gone to get credit for anything. Hold a second. Chris P. Tacos 84. Hey, Jason, I created a 3D CGI rendering of your logo with Advise Edge as a thank you. Did you ever get it? Actually, no, I don't think I ever got that, Chris. I'm not sure. Did you send that to my Advise Edge address? Yeah, so that'd be, if you have that, that'd be great to send that again, and maybe I can start using that logo. Doug B, one of my favorite guys in my Patreon group. Hi all, risk management to guard against high valuations, black swan, etc. Thoughts on stop losses, or don't bother because of the long-term strategy of using stop losses, how to pick triggers. So for a lot of the folks who are watching this right now, or who are subscribers to my channel, a lot of the folks are a lot younger than you and I are, Doug. And stop losses to them seem to make a lot of sense because they probably don't have a lot in the way of gains, and they're not worried that much about taxes, right? If you are a little bit older, you've been investing for a lot longer, you have some positions that are pretty old, and when they're pretty old, they've got a lot of gain in them. And if you're a long-term investor, like I've been a long-term investor now for 20, 25 years, I'm still looking to invest 20, 30, 40 years in the future. So I am still looking at probably not doing a stop loss, except possibly on positions where my cost basis is high already. Like I sold some cover calls on Sofi because my average on Sofi is actually relatively high, but I also sold some cash secured puts on Sofi because I still want to acquire, right? I want to generate that extra income. I still want to acquire. But one of the things that you can do for downside protection is you can do stop losses, or you can also buy puts. Puts are actually really expensive right now compared to where they've been historically. And I don't advise buying and selling trading puts as a strategy. If you want to buy a put, do it as a risk management strategy. I think it's a great risk management strategy. And if you have positions around where you've got a lot of growth in it and you want to lock in a price, writing a call on one side of that equation and writing a put and buying a put on the other side is a good way to put what's called an option collar around a position, where as long as it stays within a certain range, you're going to be okay. The cost of the cost of the put versus what you got for the call should offset each other for the most part. You'll lose a little bit of money because the put will cost you more, but it will protect you from on the downside. But it limits your upside potential a little bit too. So yes, I'm not a huge fan of stop losses unless you have high cost basis in there. You don't care if you sell because it doesn't cause that much in the way of taxes. But an option collar is something you may want to consider if you own at least 100 shares of something and you can sell and you have plenty of capital gain in there. So Trend says R1T efficiency is terrible. So let's get something clear about efficiency in general. 8 years ago, I think it was 8 years ago, Tesla came out with the Model S. 8 years later, there's nothing that is more efficient than the Tesla Model S. There's no battery that's comparable where you get more range than the Tesla Model S. Tesla was so far ahead of everyone that they make everyone look really, really terrible. So the R1T efficiency really isn't all that terrible. If you're looking at terrible efficiency, look no further than Ultium, which is GM's battery platform. It's they're boasting a longer range than Tesla right now, but they're comparing their 200 kilowatt batteries to Tesla's 100 kilowatt hour batteries, right? So it's a really terrible comparison. So nobody has a battery management technology that is quite like Tesla's is at this point. So I think it's a little bit unfair to compare them, right? So they are looking at putting, I don't know if they're doing that now with the first models that are coming out, but they're looking at putting much larger battery packs into their trucks than anyone else is right now. At least that's what I was reading in an article like 3 or 4 months ago about them. But I'm just excited that there's an electric truck out there that actually looks like an electric truck, right? And not the Cybertruck. I'm buying a Cybertruck when it comes out for 2 reasons. Number one, I don't give a crap what it looks like because I'm not a traditional truck driver. I just needed to tow my boat, and I don't want to pay for gas ever again. But the other thing is that I'm really fascinated with some of the design features of the Tesla Cybertruck. But I do see the point when it comes to Rivian's truck. I think it's going to sell just well. I think they'll have no problem with demand. Their problem is going to be, can they produce fast enough to meet demand and make sure that there's not a competitor that steps in and steals their market share? And that's the real question. Like, Tesla has had this race to produce more without any competition in their space. Rivian is going to have this race to produce as much as they can, with Ford nipping at their heels, with GM nipping at their heels, and with Tesla coming on next year too. So as much as I like the idea of Rivian, as much as I like the truck may not be where they end up putting the majority of their focus. I think it's actually probably going to be on those delivery vans for Amazon. I think and this is a really bad comparison, but this is the R1T is basically the Badger. Remember Nicola's Badger, the truck that they designed. It was basically a $12 billion piece of artwork, since none of them were ever produced. But what it did is it got investor interest in the company. People really aren't as interested in investing in delivery vans, even though there's massive business in delivery vans, right? But I think the R1T gets folks interested in their company. They're able to, go big on their IPO. 6 months from now, 8 months from now, I can guarantee this is going to happen, because they only issued, I think, 11 million shares. There's going to be a secondary offering, and there's also going to be some very low interest convertible debt that's issued. That is 100% guaranteed to happen. So one of the big secrets of Tesla's success is, in the last couple of years, they've issued a lot of zero coupon convertible debt, meaning they're able to borrow money from investors at zero cost. As long as the stock price goes over a certain amount, the investor can exercise, convert it into shares, and that's it. And in a lot of cases, Tesla had to pay zero interest on the money that they borrowed, and all they did was dilute, other shareholders. So yeah. But in that case, yeah. Let me see here. With inflation, do you think there'll be a flight to Bitcoin like other YouTubers? No, I don't. So with inflation, there is a flight to other assets. I don't think there's going to be one to Bitcoin. There's not even a clear correlation between Bitcoin and inflation right now. And to be honest with you, the volatility in Bitcoin, I like it as a long-term investor. If I look at that trend line since 2011 or whatever, it's basically been straight up. If you look at the entire trend line, if you look at any brief period, though, it's up and down, it's up and down, it's up and down, and it's highly volatile. The money's going to go into gold. It's going to go into real estate. It's going to go into businesses that really can't. I think that's a big difference right now. It's going to go into businesses that aren't going to be disrupted in the case of adverse business environments, like we saw. Like, it's not going to go into restaurants. It's not going to go into anything like. It's going to go into supply chain things. It's going to go into the bread and butter items, and it's going to go into rental real estate. Rental real estate is already super, super high. If you look at yields, I was talking about rental real estate last year at this time, and people were telling me, oh, well, it's only 10% below where it was before 2020. And I'm like, yeah, it's an incredible opportunity. If you'd have bought REZ, like I was talking about the EFT REZ, it's up, like, I was looking at it today, it's up like 56% over where I talked about where it was last year. I think 56%. And the dividend on it is so small now because the prices of those REITs, it's a REIT. REZ is a REIT of REITs, right? So those other REITs inside that portfolio have appreciated so much that it's driven the yield down. So I'm looking at a 56% return on that investment over a year. Plus, it's still making like a 2% dividend, where I really bought it for its 3.5% dividend at that time, or close to 4% dividend at that time. So yeah, so I'm very interested to see where money flees to in this case. I think you're going to see some high-profile people with their flight to Bitcoin, but having worked with the wealthy for a very, very long time, I can tell you that very little of their wealth is going to go into Bitcoin, and most of it's going to go into other hard assets. So Epic Cancer says, there was a question about Proterra. I own some also. Thoughts? I want to say something about Proterra, but right now I'm not sure if I'm confusing it with the three-wheeled electric vehicle company, or is that Aptera, or is that Solo? I'll have to think about that, because I looked at Proterra about 2 weeks ago, and I wanted to talk about that, but honestly, I've kind of forgotten about that. Oren says, I get it. NFTs are like metaverse video game items. Yes. yes, in a way, but it's so right now with like video game items, there isn't a way to create scarcity without doing it artificially. And that way you only have fixed prices for things in video games. People can't like bid for them. There's no market for them. So NFTs are going to allow you to create scarcity for certain items and even like certain capabilities. Like you could be buying weapons in video games. There's only 4 of these around. People are going to bid for them and pay for them in like video game coin, right? There's a little bit of that market going on right now, but what you have artificially enforced scarcity. In this case, though, you're going to be able to, like, players are going to be able to create items on their own, weapons, whatever they're creating inside of the video games. They're going to be able to create their own version of scarcity for it. There's going to be markets for those items now. So, and if you don't believe me, this is already happening. I was talking to a video game developer. He's like, dude, we're working on this as a secret. How did you know? I'm like, well, it's the next logical progression for me. Is that you find a way to tax that rather than having to create it the entire time. You find a way to tax it in your video game, right? So yeah, that's part of the evolution of NFTs that's going to happen. Doug B, once again, one of my favorite guys from the Patreon group, says, have you been on the Tesla Loop tour in Vegas? I heard someone tell the other day what it was and how much people enjoy it. I have not been on it. I haven't been to Vegas in a while, actually. I have a love-hate relationship with Las Vegas. So I read a book once on like how to play blackjack, and if you guys haven't figured out right now, I get a little obsessed by numbers. So I read a book on how to play blackjack, and I went to Las Vegas, and I had all these plans for things that I was going to do, and then I ended up playing blackjack for like 20 hours straight. And after I was like, you know what, I just got to stay away from the casinos, right? So but that evolved into me like not going to casinos ever again, really, and not going to to Las Vegas. So the last couple of times I've been there, it's been either for jiu-jitsu tournaments or for fights. But next time I go there, I'm going to try out the Tesla Hyperloop. Okay, that much I can promise you. Has happens. Have you seen Planet Watch on Algorand blockchain? I set up my AWare element sensors. It seems cool, but I'm not sure about the utility. I have not seen it yet. There's so much happening with Algorand. Algorand had a little bit of a price spike today. That's not what I'm talking about. There's so much happening with Algorand in terms of its usefulness growing, in terms of its use cases. They have made it real easy to develop on the network. In fact, Adam in our Discord chat today was making the point that the reason no one wants to use Cardano, and there's not a lot of development going on for Cardano right now. There's not a lot of applications being written for it. But one of the reasons is nobody wants to learn the language. I forget the name of the language, but the programming language is kind of difficult, right? And a lot of the other blockchains use programming languages that integrate with or are very similar to Ethereum's programming language. And Algorand makes it very easy too with their programming language. Algorand's real big advantage, though, is it's just one of the most mature and professional communities out there, and they're operating like a real disruptor is, right? So if you guys have never read Clay Christensen's book, the Innovator's Dilemma, when it talks about disruptive innovation, number one, that is the book that eventually created ARK Invest, that created Cathie Wood's philosophy. There's debate on whether or not the theory is actually correct, whether it actually works. I think it's a very useful lens in looking at how to invest for the future. That's one of the things that people don't talk about. When you read on anything that comes from the financial industry, anything that's handed to you, it always says on there that past performance is not an indicator of future performance. But you're almost always seeming to judge a company, especially the companies on the S&P 500 or on the Dow. You're judging it by what it did in the past, not what it's going to do in the future. You're saying, well, it's been steady in the past. I see steady growth in the future. So number one, that's not necessarily true. You can't judge the future performance of any stock based on what it did in the past, right? And there hasn't been a useful way to frame those thoughts until the Inventor's Dilemma, the disruptive innovation came out. So I would highly suggest that you read this book, right? So yeah. Oh, so super chats are on. Yes, they are, Chris Palmer. I'd love to have a beer on you. I just cracked my second one. There was a live stream a few back where I had like 3 or 4. Well, no, it was a Patreon meeting. I had 3 or 4. My wife said, "Don't do that again." Yeah, but so I will not be having 3 or 4 beers on my live streams. But ask me anything you want, guys. Check out NLST patent infringement case against Samsung Google Thoughts. So ask me on the next live stream. That's not something I'm familiar with at this point. So yeah. Rivian's competitor is Ride if they get their acts together. No, Ride's gonna go under. And so I made a video on that a few months ago, and it was really after they had their biggest misstep is that they are not trusted by financial markets anymore. Meaning, if they wanted to do a bond issue, they would actually have a hard time finding someone who would underwrite that bond for them. They're going to have to find basically private equity support to continue. Now, they got that. They got a commitment for something like $600 million. The problem is their burn rate's close to like $100 million a month. The other problem is that the commitment of $600 million from this private equity group was contingent on a bunch of them achieving a bunch of different milestones, which to me looked sort of impossible to do. So yeah, hold on a second here. So I think that is not going to be their competitor. Unfortunately, is really going to be Tesla and Ford. The Ford Lightning is supposed to be coming out next year. So yeah. So have you looked into PSTH Bill Ackman's SPAC? Isn't this the second SPAC he had? Wasn't he the one that had to return some SPAC money here recently? Oh, actually, Chris. So apparently on this one screen, so on the YouTube side, the super chat stickers or super stickers come across like really, really big, and you can see it on the YouTube side. On this here on StreamYard, the software that I'm using to stream, it doesn't look quite as cool. But thank you, Chris Palmer, for the super chat. Yeah. So Cardano uses Plutus. Has happened says Cardano uses Plutus and Marlowe, which is why it's hard to build on. There's actually something else that they use too that I was discussing with someone, and he actually just absolutely hates working with Cardano. And this is not Adam. This is another software developer. So Frantic Pillow says, Frantic Pillow, I haven't seen you in a while, buddy. How you been? I'm buying Facebook, Spotify, and PayPal at the moment. What returns can I expect in 3 years? So, look, this is all just speculation because I can't tell the future. No one can tell the future. But in terms of Facebook, their revenue growth, their ad revenue is still growing. You can say what you want to about Facebook, encouraging extremism, the company putting profits over people, which to me is just what companies do. The business of a business is business. It's not protecting people's feelings. And I don't see them as being evil. I see them as just being a company. Like, smack them down. Let's move on. So their revenues are still growing. I still say that it's going to be a good investment in the future. How successful is their Meta platforms going to be? How are they going to get into the metaverse? And are they going to create a great metaverse experience? I don't know that they will. I know this is something they've been working on for a lot longer than you think. They acquired Oculus Rift Oculus a long time ago, sort of in preparation for this. But I think that technology nerds like myself have been wanting and preparing for a VR world for a very, very long time. Like in the late 1990s, I was extremely excited about VR technology. I can't remember the name of the VR headset that I had, but the VR sword game that you can play now, there was something similar back then. There was a flight simulator that was pretty good. The graphics weren't that great, but the 3D experience was there. It was just a really blocky 3D experience. So I'm curious to see what happens with them. I don't know that they can make that transition. I think this is looking back at like the innovator's dilemma. I want to go back to the point I made about Algorand. But looking back at the innovator's dilemma, I think it's going to be a smaller company that ends up out competing Facebook in terms of terms of the metaverse eventually. Now, What Facebook will probably do, because they have so much money, is acquire that better competitor. That's probably what they'll end up doing, is buying them out. And I don't see them going under. So I think Facebook's still a good investment here for the near future. Spotify, interestingly enough, I see Spotify being replaced by something else. Largely, and honestly, in ways, in some ways, NFTs may actually spark this change. There's a lot of discussion right now about how artists can deliver their own artwork to people directly to bypass Spotify. You need hundreds of millions of plays of something to make a living at doing music right now. And essentially, if you're not signed by a major label and they don't cut you $1 million check and put you on a tour right away and your tour sells out, you're not making any money. Like I know people have been in the music industry for years and years and years, and they all have other jobs, right? And even though they might play relatively full time, they all have other jobs too. So Spotify is not something that I have tons of faith in going in. PayPal, on the other hand, they had a bit of a stumble recently. I do think that PayPal keeps marching on. The fintech revolution here is in full swing. More and more of what we did in our financial lives is moving. It's moving out of the traditional world and into a mobile first world. The old players are simply not able to keep up. Zelle was the banking industry's greatest attempt so far into the fintech space. Zelle works just fine, but I can do everything that I can do. I can do 100 different things on Sofi's app that I can't do on Wells Fargo's app, right? I can do the same things with PayPal. I can do the same things with Cash. I can do the same things with a half a dozen other apps out there. None of the major banks are keeping up. Now, that doesn't mean they're going to destroy the major banks, but it does mean, because there's so much money in motion here, you're looking at $500 billion accounts that are up for grabs in the next couple of decades. It does mean that I think PayPal, I think Cash App, and I think SoFi is going to be the big growth story in the next 10 years. But I think that owning PayPal or owning Square is really the way to go too. I think that, yeah. All right. Just came into me. Haskell is what Cardano uses. Yes, that is what my friend there was complaining about. The other point I was trying to make about Algorand being the disruptor is that they aren't targeting. Algorand is not really targeting like big players out there. They're going after like the Marshall Islands, Nicaragua, Panama. They're writing these companies or these contracts with sovereign governments for or central bank digital currencies to handle that on Algorand's blockchain, for remittances to handle that on Algorand's blockchain, and they're doing a lot for that. Like I think I explained in one of my last live streams that the Marshall Islands is kind of unique. That more Marshall Islanders actually live off of the Marshall Islands than live on the Marshall Islands. So remittances, sending money back home, is kind of a big deal, and wire fees going to the Marshall Islands are really expensive. So Algorand came up with a solution for that, and that the government completely approves of. So I do see more and more adoption of Algorand in places you're not expecting. South America and Central America seem to be the place where Algorand is being adopted as a blockchain technology, whereas Ethereum and Bitcoin isn't necessarily. Now I know Bitcoin is accepted as legal tender in a couple of different places in South America. I think, is it Uruguay or Paraguay or maybe both of those? I don't know. So let me see here. Patricia Chow. I don't know if that's your real name or how to pronounce that. Is that name Polish? It says, what do you think about buying land in a metaverse, Decentraland? Any price prediction for it? So I don't know that Decentraland is really going to end up being this giant player in the metaverse space. Like I said, and like Adam said, there's going to be multiple metaverses. I do think that at some point, digital real estate is going, just like real estate in the real world, is going to be worth quite a bit in certain places, in advertising space and business space. Like I can honestly see that any sort of service-based business in the next 20 years, like even me being a financial advisor, or maybe your exercise coach or something like that, like a personal trainer, I can see a lot of that moving into the metaverse. Humans are going to congregate in certain areas in the metaverse, just like they do in the real world. because it's all about social dynamics, interaction, and status. That's going to happen in the metaverse as well. The dynamics are going to be a little bit different, but relatively similar to the real world to some degree. But it also means that digital real estate is going to be valuable. It already is valuable. Look at getting, and I'm not talking about in the metaverse, I'm talking about digital real estate. Look at getting advertising space on the front page of any major website that's well known, and you'll see it's already extremely valuable. That same thing is going to happen in the metaverse as well. Now, is it going to be Decentraland that has tons of of digital real estate that's actually valuable? I don't know, and I don't think it would be responsible for me to put a price prediction on anything. I haven't heard of plots of land selling in the hundreds of thousands of dollars out. So yeah. I believe PSTH is, this is Bill Ackman's most recent SPAC. A deal with Universal Music Group never came to fruition, sort of in limbo around $19. So I'm not the biggest fan of Bill Ackman, I'll be honest with you. So I don't want this to color your opinion of Bill Ackman. But Ackman, in my opinion, is not necessarily an innovator. He would not be, so when I'm looking at SPAC mergers, I'm looking at mergers with new and innovative companies. He has never been known, he's an activist investor, but he's never been known as an innovator. So I would not be naturally inclined to study something that he's putting out, right? And I hope you understand what I'm saying. I'm not trying to trash the guy or anything. He's just a different style of investor than I am. And well, obviously, he's a more successful investor than I am. Maybe I should be paying more attention to what he's doing. I don't have billions of dollars like Bill Ackman does, right? But no, so that's not something that I would necessarily look into quite heavily really early. I've been off the SPAC bandwagon for a while. I did a kind of a video like in January of last year called like SPAC Massacre or something. I don't know what it was, but just saying that the market for this was going to dry up at some point because they were now at that point. There were something like 400 registered, shell companies all out there looking for companies to merge with, and they were having a tough time doing that. So Patricia says, yes, it's Polish. Thank you for the response. I always like guessing where people are from based on their name. I hope that doesn't offend you or anything like that. So, because I let people guess what my ethnic background is all the time. Everyone's always wrong. I just keep letting them guess. So it would be impossible to actually guess it. Because I didn't even know until 3 years ago when I took a DNA test. Oh, speaking of that, 23andMe. I made a comment months ago about 23andMe when they went public, and they were roundly trashed when they went public. Almost all of the major YouTubers just thought about 23andMe as a joke. Like, why is this company going public? They provide you DNA tests, and all they do is they tell you your ethnicity. How long is that going to last? There's a limited amount for that. Well, the DNA test was never the product when it came to 23andMe. Your genomic data that you submitted to 23andMe was the product. 23andMe was founded by the longtime girlfriend of Sergey Brin. Sergey Brin, who was one of the founders of Google. His ex-girlfriend, I think they broke up in like 2015 or something. She founded this company. And I remember reading the sort of the investor deck for this company the first time we get passed around angel investor circles, and I'm like, this is the most Silicon Valley thing I've ever heard of, which is, hey, I don't know what we're going to do, but we're going to provide cheap DNA testing, and as we provide more of it, it's going to get cheaper, and we're going to gather all this data. And then we're going to get insights from the data. By the way, we don't know what insights we're going to get from the data, but we're going to get insights from the data, and then we're going to sell the insights. And I'm thinking to myself, this is incredible. This is the most incredible pitch I've ever seen in my life. And I was like, it's so empty and valueless. And I passed on investing in it at the time. I'm not kicking myself yet, but I imagine that 5-10 years from now, I'm going to be kicking myself for passing on this. And I was part of an investment consortium, and I voted, and everyone else voted too. I don't think there were any yes votes, but the whole idea was like they had a company that did not have a plan other than to collect data, and use DNA testing to collect data. So later on, they could sell the insights gleaned from millions upon millions of people in the database. Well, that strategy is starting to pay off. they're starting to have revenues now that are not from the $100 that you pay for a DNA test, but they're selling that data and those insights to different companies that are looking to develop treatments and medications. That is starting to happen, which I don't even think most other financial YouTubers, because they're not into genomics like I am, I don't think they realized that was kind of the goal, and they didn't research deeply enough into the company to understand that that was kind of the goal of the company. Like I knew that and just didn't understand how they were going to make this work. So yeah, very, very surprising, extremely surprising. We see here, Has Happened says, "Are you from Mars?" I am not from Mars. So. Frantic Pillow says, "You're a copy of my dad." Depending on how old your dad, actually, now I know who my father was, but I used to not know who he was. I would have been like, "Hey, man, maybe he's my dad. You don't know." Too bad he sucks at investing. So most people suck at investing. I hope you guys understand that. I can tell you that working as a financial advisor for most of my professional life, that I have very few people that I can actually meet with, meaning that based on the sort of limitations of the industry, when you work for a registered investment advisory firm, you really can't work with anyone who has less than $1 million or so. So that kind of limits you right there. And it's not at least a pathway to having like $1 million invested. They just don't have a financial life that's complicated enough to need that, even if they want to do flat fee planning, which is 95% of my business, or they don't have enough to do an assets under management relationship that's not really taking advantage of them. And we can talk about that at some point. I think that a lot of the fees that are charged for an assets under management relationship, if you have under $1 million, you're paying way too much. First of all, you may not need that, but second of all, you're probably paying too much. But I can tell you that most people suck at investing. Most people suck at saving. I'm only able to work with about 4% of the population. That's it, right? And even when I worked in the private bank at a local or a regional bank here in Southern California, I still only had access to about 4% of the population in that bank, because that's just the way money works. Capitalism is a really strange thing. It's the best system for everyone. Capitalism is literally the best system on the planet. It's a terrible system, but there's not one better. The problem with capitalism is that most people actually suck at capitalism, and income, power, and wealth gets concentrated at the top. And so we have to do something about that occasionally. Kirk Vance says, "Love your channel. Do you advise or mentor folks struggling with understanding how to transition into crypto and subsequently invest?" So there are a number of so unlike a lot of other channels, I do this professionally, so I have to be careful about what I say on a live stream. And I can say this, that a year ago I would say that crypto is not an investment, it's not an asset class, it's purely speculative. I will say that it's still purely speculative, but it's becoming and behaving more like an asset class at this point. But beyond being an asset class, we're looking at it having real utility here in the future. Like DeFi, decentralized finance, is starting to take off. So be careful about decentralized finance. A lot of it is not really decentralized. When I started looking into a lot of these companies, and I'm not going to name names yet, I want to make a video about this. But a lot of these companies that have these DeFi apps, when you do the research, it turns out that there is one beneficial owner of that company, right? It's one beneficial owner of that company, or it's 2 or 3 beneficial owners of that company, and they are the ones who have the most influence over that community, right? So it's not really decentralized. But that space is evolving, and that's going to happen, right? Adam, in my last live stream, when I had him on as a guest, he made the point that it may be that none of the blockchain technologies we like right now are going to be ultimately, there's going to be several different blockchains. Blockchain is here to stay. It's not going anywhere. It's not going to be one blockchain that's successful. There's going to be several of them. Leading candidates right now, I'm not saying going out and dump your money in there. I'm saying that there are applications being developed, and there is money being poured into this ecosystem. We're looking at Avalanche, Solana, Algorand right now, or your big three where a lot's going on. I know that there's a lot of active, and I'm not mentioning Bitcoin and Ethereum because those are already ecosystems that are working. I'm talking about the up and coming ecosystems that are looking where you're going to have serious functionality on those networks here pretty soon. So yeah, and it has happened says immediately Ethereum. Yes, no, of course, but I didn't mention them just because they're already established. But Kirk, thank you so much for saying that you love my channel. I love all you guys that come on my live streams. I used to be seriously nervous about doing these. Then I started drinking then a live stream. All right. Steve O says, any thoughts on Upstart and PayPal? So I've been asked a couple of times to look into Upstart, and I've started to look into Upstart. And so the lending business to a lot of people in finance who are not in finance can seem a little bit boring, right? And one of Upstart's big deals is that there's basically 30 factors that the regular financial industry looks at when they're considering who to loan money to. That's a lot of different factors to look at, right? And even people like, I have an excellent credit rating, but I actually, because of the way my income is structured, because of how many businesses I own and how everything gets passed through several different businesses before it ends up in my pocket, it makes my finances look really, really weird, right? So it's actually hard for me to get just a loan or to refinance. I would probably not be able to refinance my home. I can refinance a rental because they've been rented out for years and I can show they're making money, but I probably would not be able to refinance my home because of how odd my income looks, right? So Upstart started off with this supposition that many people that are denied prime credit probably don't deserve to be denied prime credit. They've got good credit ratings. They got something that makes them look funky because they noticed that 80% of Americans do not default on their loans. And yet only 42% of Americans can actually get prime rates on lending products. So basically half of the people out there who have never defaulted on a loan are being denied prime rates for no good reason. And this is Upstart's, this is one of their, the main focuses of their business. They use a different approach and a different way of analyzing the financial data to get more people who probably can't get really good rates at traditional financial institutions and to give them better rates and cut their costs with lower fees on their platform. I was not a believer in this company when I first started looking into them. I looked into them and I didn't understand why they're so popular. I didn't understand why their stock had gone up so much. But the more I looked into how and why they started the company, the assumptions they made, and so I became more and more impressed as I was looking into them. So I don't own any Upstart stock. It's not something I'm probably going to add relatively soon, just because I've got a lot in that fintech space already. And right now, so the money that I'm making right now in my investment portfolio is actually getting pushed into like a lot of boring stuff right now because I need to build up my portfolio, the boring side of my portfolio. Right now, I have enough in tech, I have enough in fintech, I have enough in EVs, I have enough in AI and a lot of other technologies. I'm going more boring for a little bit, which means I'm buying some dividend-paying stocks, I'm buying some ETFs, more VTI, more. I'm actually trying out some of the covered call ETFs right now, like QYLG, which half the portfolio they write covered calls on, half of it they let it ride, so you can grab some of the growth. And then XYLG, which is the same thing but on the S&P 500. So I'm going to try some of those for a while, see how well that works. And I have no reason in particular to be uneasy about the stock market, right? So most people who look at the stock market and are very nervous right now, the extent of their due diligence is this: it's the market has been too good for too long. It's been going up too fast. Something has to happen. It has to crash. No, it doesn't. The market doesn't have to do anything you think it's going to do. And there's no logic behind, you have to have a logical reason for those beliefs. Otherwise, you're just pulling out of your ass, right? They never provide you with numbers behind that. They never provide you with indicators behind that. What I'm seeing right now is the case that the price to earnings ratios are a little bit high right now. They're historically high right now. But that is not 100% an indicator that there's a crash coming. People are a little bit worried about inflation, but that's a concern that has popped up over and over and over in the last 25 years or so, 30 years or so that I've been investing. No, so there's not a reason for me to be uneasy or nervous at this point, but I am preparing a little bit right now for a kind of a crash in tech, right? I want to have money on the side or in safer assets right now to move into tech when things decline in value. So I don't know if you guys watched one of my videos that I made I think a week and a half ago. I got caught out on Tesla, man. I had 200 shares of Tesla got called away. I got greedy and I sold call. Normally I sell calls that are so far out of the money that there's no way they're going to get executed. And, I make $250 on a week-long call. Like, for example, Tesla's at $1,050 a share right now. On Friday, I'll probably sell a call for, or Monday, I'll sell a call for like $250, and I'll sell a call for like $1,450. So if the stock goes to $1,450, well, then I have to sell my shares. I got really greedy though, and I started making like $2,000 a week, right? And finally, right before earnings, I sold a call at like 9:20 and 9:25, and I was fine on Friday. When I woke up on Monday morning, boom, my calls were in the money, and I had the choice of letting those sell or buying back the call. I ended up buying back the calls, eating the loss instead, which meant also that I had to so when I had to I started to eat the loss on one of those actually got called. The guy called it right away. So when I had to get big in, then my loss ended up being about $18,000. I ended up missing out on about $18,000 of gain. So let me see here. Has happened says, got to head off. Have a good night. Hey, Has, you're always on my live streams. I know you've posted me in Orange County. If you're down in San Diego, let me know. We'll go out and have a beer or 10. And yeah. And DG says, based out of Wyoming. Awesome. Have you heard of Blocks? It's the first registered DO LLC in the world. Are you talking about the DAOs in relation to NFTs? Is that what you're talking about? You have to be a little bit more clear about that. Tobu NCS says, hi, Jason. How likely do you think a crash or a correction is at the moment? So typically, based on, and it's always a danger when you say typically, but in any 6 or 7 year period, you generally see a bear market, right? In any 6 or 7 year period, you generally see a bear market. And at least every 18 months, in general, you would see like a 10% pullback in the market, right? Those rules have been sort of thrown out of the window in the last 13 or 14 years. We haven't seen sort of regularized behavior in the market. But no, do I think a crash or correction is imminent? No. Does it mean that I'm not preparing for one? No, I'm definitely preparing for a pullback in the market. I don't think there's going to be a crash. There's no indication of that. I do think there's going to be a realignment of assets away from tech into safer things here in the future. That's going to be led by older investors, people those are the ones who have the money, by the way. But people who are a little bit older than I am or my age, who are looking to buy things like REITs, real estate that pays dividends, looking to buy Coca-Cola, looking to buy basically your dividend aristocrats, which have not been a popular investment here in the last couple of years. But I think that as some of the appetite for risk starts to dry up here in the near future, I think that those more boring assets are going to see inflows. That happened a little bit last year, like February, or earlier this year, like February and March. There was kind of a shift from money away from like risk assets into these more boring like dividend aristocrats. Those are definitely safer assets to own. Coca-Cola, if you buy Coca-Cola, it's pretty difficult to see how they're not going to grow their revenues over time. And Pepsi Cola as well. Like Pepsi as a brand, like just the drink itself is second fiddle to Coca-Cola. But as a conglomerate, they are a great company. They own lots of food and beverage products that are going to be used. They're going to steadily grow their business forever. They're going to steadily grow their dividend payout pretty much forever. Though I think I see those as relatively good assets here in the future. I have a friend of mine who has another channel, and he and I are radically different, by the way. His name is Josh Scanlon. He owns Heritage Wealth Planning. We're very different people, very friendly, and I like the guy. He really got me into YouTube. He's the one that encouraged me to do this, even though I didn't know him very well and he didn't know me anything. He helped me out a lot. But he has made the point that there are some folks that are predicting that the S&P 500, in the absence of dividends, is expected to not have any return at all in the next decade, right? In the absence of dividends. So dividends right now make up like 1.92% of the return. Like it's the dividend yield of the S&P 500. I think it's actually like 1.76%, not 1.92. 1.92 last year. Now it's 1.76% because it's gone up so fast. So without dividends at all, you're expected to make no compound returns over the next 10 years. Now, not everyone. This is a couple of different people that are making this prediction. Predictions aren't worth very much, folks, though. Guys, let's look at professional money managers and financial pundits, even me. If I'm making a prediction about the future, take it with a grain of salt. Humans are really, really bad at predicting the future, and particularly the financial future. But there are a number of experts who are claiming that there's not going to be a return in the market without a dividend in the S&P 500. So if you're going to get a return in the stock market, it's going to be in a disruptive and growing industry. And we're looking at thematic investing, maybe kind of ruling the roost here market-wise for the next decade. When I say thematic investing, like genomics, autonomy, AI, next generation internet, electric vehicles, electrification of transportation in general, green energy. But your older, more established companies, we may not see a ton of growth in those. But people want that for people want to own those assets for safety. But anyway, Kirk, I hope that was a really long-winded answer to your question, but I hope that kind of helps you out. So Anuj Gupta says, what do you think? Why house market on us did not come down even after eviction moratorium was lifted? Okay. So I was in the middle of it during the 2008 crisis. I worked in a regional bank that had a fantastic real estate portfolio. In fact, it was not a huge bank. And if I said the name of the bank, you'd be surprised that the number of home loans they had was so small. But they had 4,800 home loans on their books. They had 2 defaults. That's it. Right? And the 2 defaults were actually related to this program where the government forced this bank to make loans to people who probably didn't qualify for the loans. And literally because there was a certain ethnic group that tried to borrow from the bank. Both the people that tried to borrow from the bank were turned down. They sued the bank saying, hey, it's because of our ethnicity. The bank decided to settle and just like, okay, we'll make 2 loans to people in your ethnic group. Not you guys, but 2 other people in your ethnic group. Well, anyway, those are the 2 loans that failed. And I'm not going to go into why that is, but they had a bulletproof portfolio. But what this bank did was a ton of research on everything else that was going on in the banking industry at the time. And what they found out is that banks lost hundreds of millions and billions of dollars by evicting and by taking over homes. They simply were not in any way equipped to deal with the massive flood of foreclosures and the massive flood of evictions. They just weren't prepared for that at all. This time around, I'm looking at everyone that I know personally and professionally who was unable to pay their mortgage for a couple of months. They just got tacked on to the end of the mortgage. They paid a small penalty, and instead of their mortgage being 360 months, now it's 364 months if they missed 4 payments. And they still owe the interest on that, and they still owe a late penalty on that, but it's really small. And so instead of putting these people through the eviction process and foreclosure process, which you have to pay lawyers to do that, you have to pay someone to maintain the property, you have to pay someone to take possession, you have to get the police involved, you have all this stuff, right? They're like, no, we're just going to renegotiate mortgages and spread them out this time. So millions upon millions of people got loan adjustments, and they're going to be far fewer evictions and far fewer foreclosures than there were during the last crisis, because the banks learned that foreclosing simply wasn't profitable. They did not make money on this. They want to make money. Stretching out your loan and still making you pay it just makes the time you collect those interest payments a lot longer, right? So that's the reason why that the housing market didn't come down even after the eviction moratorium was lifted. That's one big reason why. Now, if you're talking about the housing market with the eviction moratorium ending on renters, that's a whole different story. It's a whole different market. So, same thing with unemployment. Why not many people come back into the employment market? So that is a function of the press that you're reading. So the labor participation rate as of between February of 2020 or 2020 and today, the difference is only like 1.6% difference in the amount of people participating in the labor force. So there's very few people that were working in February 2020 that are not working today. I would say that a large percentage of those people, because I worked up the math and I think it was only like 2 million people or something like that. I'd say a large percentage of those people are mothers who can't find childcare, right? Or people who actually decided to retire. They're like, well, after a year of not really working or working from home or collecting unemployment, I'm just not going back to work. I'm 62 years old. I've got it made. My investments didn't crash. I'm done, right? So, but I think that politics has invaded our estimation of what unemployment looks like to a degree where it's hard for us to separate that right now. The labor crisis right now is not caused by people that don't want to work. It's people that don't want to work for crappy employers who won't pay them what they're worth or what they think they're worth, right? I own a number of businesses and have a number of employees. And I don't ever want someone working for me full time that can't afford to have their own apartment and pay for a car note, right? That's essentially if I can't spend the money to have someone be able to live on their own, then I don't deserve to be in business, or that business doesn't deserve to be in business. So, Tobo NCS says, thanks for the response. Do you focus mainly on dividend stocks, or do you look at value stocks by working out the intrinsic value based on future growth? So the couple of possible misconceptions in that question. So I do use price to earnings growth as a model to determine what I want to pay for a stock today based on where I think the stock's going to be, what I think the stock's going to be worth 5 years, 10 years from now. So pure value investing, meaning you're trying to find a company that's worth $1, but maybe the share price is beat down to like 90 cents. So that style of investing has kind of been dead for almost 20 years now. So value investing has been outperformed by growth investing for a very, very long time, where that didn't used to be the case. It used to be that over time, value investing usually beat growth, where rather than investing in what you thought future growth, you should be investing in something you think is undervalued, at the current moment. But that strategy has not worked now for about 2 decades. So it's being reevaluated at this point. But no, that is not what I do. I use a price earnings growth measure that is really my own. And I don't know anyone else is doing it. I'm a little hesitant to share it. I'm a little hesitant to share my strategy just because I'm not sure that I want to make sure that it really makes sense and I can back it up with data. I don't want to tell you guys something that it's not actually true. If you guys ever remember, it was one of the big investors used to have a radio show talking about the buckets of money strategy. Well, as it turns out, none of that was back tested. None of it's real. It may not be real. I don't want to say none of it's real. It may not be real. None of it's been back tested, and he can't prove it with any data that strategy is actually going to work. Sounds great in theory, but we don't have any examples of how it's actually going to work. So, and I don't want to be that guy either. And I can't remember that guy's name. Is Ray something or other. But yeah, Nathan W., also a frequent guest on the live stream. Hey, Jason, is there any other tax advantage account other than the Roth IRA? The Roth IRA, the traditional IRA, the HSA, the 457 plan, the 401k plan, the 401a plan. You're talking all of those things. There are a few other things that are considered tax advantaged. A few other things that I don't necessarily like to talk about because they're loaded with, basically they're just loaded conversations. There's annuities that you can take a look at. Not a huge fan of annuities. Like most annuities are sold to most people for mostly the wrong reasons. But they do have utility in certain aspects. But if you're young enough and you're looking for growth, it is not a place to park your money. A variable universal life policy also has tax benefits associated with that. It can be used as a vehicle to do a lot of things. We use this a lot as a vehicle for estate planning, but it can also be used as a way to get income in retirement by borrowing against the balance, which you do on a tax-free basis, and you're paying yourself back when you do that. So that's a tax advantage way to do that. But you would need to be in a relatively high tax bracket in order to make that work. What I'm saying is you need to be in at least 32, 35, 37% tax bracket to make these work, okay? And you need to have significant amounts of wealth in there to make that work. In terms of, so the HSA is the one account that you mentioned that I use that is severely underused by the general public, particularly anyone who gets their insurance from the exchange. Why would you not be using an HSA policy? You will, if you're healthy, you will spend a lot less money. Yes, my deductible is higher, but most years I don't use that deductible, and the money that I'm not spending in premium is going to that HSA account. And I bought Tesla stock in my HSA account, a couple of years ago, and I've done fantastically well with that. So after a conversation I had with my wife, though, I actually ended up selling the Tesla stock inside of my HSA. I don't want to have something responsible for my medical treatment to be that volatile. So I tend to have like really boring investments in there. So Newscripta says, what about renters? So surprisingly, so I have a friend of mine, a fishing buddy of mine, who has, I don't know, he has 50 units of his own in renters here in San Diego, and then he probably manages construction projects that have hundreds of renters. And he ended up having far fewer problems than he anticipated with people not wanting to pay their rent because of the eviction moratorium. He did end up eating it on a couple of different units, and he told me some very interesting stories about the people who decided not to pay, not the people that you think. So all of the rental properties that I own, the people decided they kept paying, and a lot of the folks that I rent to are not in the best financial condition. So I'm actually kind of surprised that I didn't have to eat any of that. But now that the rental moratorium has ended, I do anticipate that you're going to see more people being forced out. I anticipate that you're actually going to see rental rates rise even further than they have been in the past. Which honestly, in some markets is actually pretty good. Rental rates have not kept up with inflation. Rental properties are an incredible inflation indexed asset. If we go through a long period of inflation, signing a 6-month lease or a year-long lease gives you the opportunity to raise that rent and your income every 6 months to a year, right? Particularly if you self-manage those properties and you don't have to pay someone to rehab it every time someone moves out, you're able to use that rent to keep up with inflation. And in most markets, you can do this. All right. So that's one of those. So I tend to do this with REITs because I don't necessarily enjoy being a landlord. It's not my favorite thing on the planet. I have great tenants now. That's not always been the case, but I have great tenants now. All right. Chris T says, here's the 3D renting I was talking about. I assume you sent that to my email. I'm not going to check that now, but thank you. I'll take a look at that. Tobu NCS says, appreciate the responses. Thanks again. And Anush Gupta says, should we be worried about U.S. government debt? Can the interest on that debt, the interest actual budget money? So should we be concerned about that? If we go through an inflationary period, we should be the opposite of concerned about current government debt, because all of that debt, which has been issued for the last 20 or 10 years or so at extremely, well, really since 2001, it's been issued at extremely low interest rates. It's all going to be paid back with inflated dollars at maturity, right? So those interest payments are going to become less onerous, and we get to pay back the principal at maturity with inflated dollars. You should be worried about the pace that new debt is being added to the government. That's what we should be. So we should be, and this is a political conversation that I don't want to have, but we should be looking at reducing we're reducing certain types of spending in order to that really has a net negative effect on taxes that are created. Meaning that basically, I don't think we should be expanding government services anymore. I think we should be expanding the spending that we're doing on infrastructure. I think that is going to, and in education, that is going to do the most at widening our tax base. If you look at one of the greatest experiments in social engineering that was ever created, and one of the greatest successes in social engineering that was ever done, was the GI Bill, right? The GI Bill, people went to go fight in World War II. They didn't know necessarily that the GI Bill was on the table, but when they got back, as long as you had served honorably and done it for a certain amount of time, then you were able to go to college on the government's dime. This turned out to be, and then they redid that, called it the Montgomery GI Bill a few years later. And the Montgomery GI Bill was great. You basically, and now the post 9/11 GI Bill is essentially, if you go to college anywhere in the United States and you're a veteran and you sign up for that post 9/11 GI Bill, then you get to go to college up, and they'll pay up to the state maximum in tuition, which in some states for a state school, it's like $15,000, $18,000 per year. And then they also give you an E5's BAH, like the basic allowance for housing. So just let me give you an example. If you live here in Southern California, an E5 BAH with dependents is roughly $2,800 a month, and that's tax-free. If you get out of the military, you're going to get your college paid for up to the state maximum of, say, $15,000 here for just tuition in Southern California. Plus, you get $2,800 a month tax-free to live on. Now, maybe you have a part-time job on campus, working 15 hours a week at $15 an hour. You're doing pretty well in terms of income, and you're able to live in, share an apartment with somebody, go to school. You're going to enter the middle. If you get a degree in, some science, technology, engineering, math, whatever, you're going to enter into that workforce solidly middle class with almost no debt. It was one of the greatest social experiments we ever tried, and it was enormously successful. I anticipate that we will be trying something similar here in the future. There is going to be an initial cost for this. The benefit is that all these people going through these programs end up becoming taxpayers in the future, right? We need to widen our tax base. We have made a series of miscalculations in terms of how we raise money in this country. And we have a spending problem, but we also have a revenue problem. And hold on a second. Yeah, we also have a revenue problem here, because essentially about half the people in the United States don't contribute to the operations of the federal government. They don't pay any taxes. And we have a number of different what are called refundable tax credits, which are not tax credits at all. It's actually free money from the government. And roughly half the country is on welfare, and they just don't realize it. If you're getting the earned income tax credit, if you qualify for it, it's free money in most cases. You didn't pay that money in taxes. You're getting free money back from the government, and it's coming from someone else's pocket, right? But that's an unpopular subject to talk about, right? And so I'm not going to talk about it anymore. Jonathan, who always has amazing insights here, GI Bill and VA home loan is part of the reason people imagine the 4-person family in a suburban home, impressive sum of stimulus, and government backing. That is true. That is part of what created the American dream in the 1950s. Is the 4-person family with a car in the driveway and a suburban home. A lot of that was done with the GI Bill and the VA home loan. That vision, to a degree, has changed of what the American dream is. Let me see here. Jonathan also said thoughts on the coin or consoles. I'm not sure what you're referring to, Jonathan. Maybe you can elaborate on that in the comments. But so passage of the stimulus bill here, not the stimulus bill, the infrastructure bill. That is only a positive for the economy here. And you look at the bill on this as like $1.7 trillion or something like that. Remember, folks, that is $1.7 trillion being spent over the course of a decade. The military budget alone in the United States is almost $1 trillion annually, right? So we're looking at an additional $170 billion a year being spent modernizing our roads, bridges, broadband access, and other things like that. Actually, that's kind of a drop in the bucket compared to what we probably need to invest. And if you look at what China is doing right now, developing these massive manufacturing complexes, the money that they're pouring into technology, I don't want us to fall behind. I don't want to see a world that's led by anyone, technology-wise, other than us here in the West. And that's probably not a popular statement to make in certain circles. Here, just a second. Jonathan says, clarification: the $1 trillion coin or Fed financializing some long-term bond like a 50 or 100-year. So I think that will end up being the $1 trillion. So the debt ceiling is make-believe. It's something that we the debt ceiling is make-believe. The $1 trillion coin is sort of a way to deal with that. It's a financial innovation as a way to deal with that. But it's make-believe. It's something that we talk about whenever it's politically expedient to talk about it. Every administration has raised the debt ceiling over and over and over again. You have to remember, the thing about money is it's not exactly real. It's a tool for scorekeeping is really what it is. But financializing a long-term bond for 50 or 100 years, I think this is ultimately going to be a pretty bad idea. And the example I'm looking at here is Japan in this case, where they did a lot of things like that. And now they have debt at something like 170% of their GDP. The benefit for Japan, of course, is that their debt to GDP ratio at like 170% is something. Almost all of that is owed to Japanese citizens. It's not owed to foreigners or foreign governments or anything. But the problem is they now have a declining and aging population, and no real way to pay that back with economic expansion. We won't necessarily face that problem, but there's 100 different questions in that strategy that I would rather not have to answer. I don't want to have to come up with a solution for that. And let's be frank, I'm not going to be the one that does that. If you kick that can down the road for 50 or 100 years, it's my children and grandchildren that are going to have to answer those questions, right? Is Evergrande going to default on Friday? Will the contagion be like 2008, 2013? So Evergrande will probably default on Friday. Well, default is 30 days. I think they're going to miss that payment, but they have 30 days to pay it off before they're in default. So I think they'll miss that payment for sure. Will the contagion be like 2008, 2013? No. I think that the Chinese government is going to let a number of these companies get smacked down, but ultimately they're going to step in and stop the contagion, just like we did in 2008, and just like we did in 2020. And stop the contagion, we did a lot business-wise in 2020 that anyone who is a laissez-faire economist or a libertarian economist should be offended by, right? This was absolute government interference in keeping the economy afloat. The Chinese government is going to do exactly the same. They've learned from our example when it came to 2020 and dealing with crises. And it was Charlie Munger actually made the point that the Chinese are better at managing these crises. They're better at managing the crises because their government has more power and they can do things that ours can't. I'm not sure that I want our government to have that power. I don't. So if you guys haven't figured it out right now, I'm not necessarily someone who thinks that the government should step in and manage and control everything. All right, and getting to the end of my beer. Got a half a beer left. You guys keep asking questions, and I'm getting a little bit more honest and open here as I drink more beer. What is the phrase in Latin? In vino veritas. In wine, there is truth. I don't know how to say beer in Latin. So anyway, back to contagion in 2008 to 2013. So will it be like 2008, 2003? No, but is already contagion happening? Absolutely. There are a number of other property developers in China that are defaulting on loans. Evergrande seemed to be the sort of indication to do that. But got to be honest, man, this looks like it's been coming for years and years and years. And we've all heard stories of ghost cities in China that have been built and no one's living there. And that's been one of the main ways that kept people employed in China. We have that 100% employment rate. But things are rapidly changing there. infrastructure is rapidly being upgraded in China. I'm actually planning a trip to China here. I just talked to my wife about this today. She hates the idea, of course, but I told her that I want to go to China. I want to go to like a Neo dealership. I want to go to an Xpeng dealership. I want to drive the cars around. I want to go to Shanghai and see, like, when I went there 20 years ago, it was very different compared to what it is today. I was even impressed back then, but I'm looking forward to going again. And I'm going to do that in the next year or two. I'm gonna go to China and take like a month to just travel around and see things. So, well, even if China does stiffen like we did in the U.S., it was still really bad for a lot of families. You're saying the crisis was bad for a lot of families not stepping in. Yes, but so I mean, there are a lot of things happening right now in China that's really bad for families. Rural areas are being completely and total, just like in the United States. Rural areas, for the most part, are being left out of economic development here. That's even more true in China in this case. The Chinese rural populations are in desperate poverty compared to the coastal areas. And I think, and I watched a couple of different documentaries recently where that was not the aim of the documentary, but that's what you got out of it, is that the rural areas of China are in absolute dire situations in terms of poverty here. So, all right, man. Let's see. Jonathan says it'll be interesting to see the EM blowback, even if China can keep their crisis in control. Heck, even tertiary exposure like the British property that some China CEOs have helped drive demand for. I do think that is true. Did you guys hear that story? Did you guys see that story that one of the casinos in Las Vegas was fined $500,000 because they looked the other way because some Chinese billionaire brought in duffel bags over the course of a year, totaling about $100 million, and gambled that away. So they got fined $500,000 for $100 million in revenue from this Chinese billionaire bringing in cash in duffel bags. Hell, I'll pay that fine. Yeah, I'll pay that fine too. They made $100 million off of this guy losing that. So very interesting. All right, so I just got a text message from one of my friends that's watching the live stream, and he says that it's apparent now that I'm getting drunk. So it should be time for me to go, and I'm starting to get a little bit hungry. Once again, guys, thank you so much for the super chat. And Chris P Tacos 84, I'll be looking in my email for that 3D rendering of my logo, and I'll start putting that on some of the videos. Anyway, folks, nice to talk to you guys again. Next time, I'll give you a little bit more warning. I try to make Fridays at 4 regularly. I just wasn't sure I was going to make it, so I didn't. Not Friday. I was trying to make Wednesdays at 4 regularly, but I just wasn't sure I was going to make it this week. But thank you so much for attending, and I will see you folks next time.